Hey guys, welcome to this explainer. If you're an accountancy student gearing up for the Philippines CPA licensure exam, the LCPA, you have landed in exactly the right place. Today, we're essentially hacking your study process. We're taking the incredibly dense, sometimes super overwhelming topic of final withholding taxes on passive income, and we're turning it into a cognitive cheat code. This explainer is specifically designed to help you lock down these Philippine tax rates, not just for tomorrow's quiz, but for the actual board exam 2 or 3 years from now. So let's get your brain wired for success.
We've all been there, right? You cram a massive table of tax percentages into your head at 2 a.m. You manage to pass the exam, and by Saturday, it's completely gone. Just poof. So how do you memorize these tax rates today and actually still remember them when you're sitting in that LCPA testing room years from now? Well, the secret isn't reading the textbook 10 times over. It's about how your brain naturally works. We're going to use chunking and visual anchors. By grouping similar rules together and linking them to really strong concepts, we literally lower your cognitive load. Basically, your brain is about to open specific mental folders to safely store all this incoming tax data.
All right, here's our game plan. We're opening 5 of these mental folders today. First, the nature of final taxes. Second, the bank vault tax. Third, the creator's cut and dividends. Fourth, the jackpot. And finally, the ultimate LCPA bullet review. Let's jump right in.
Folder number 1, the nature of final taxes.
Okay, so first things first, what actually is a final withholding tax, or FWT? Think of passive income like money making money while you sleep, like interest growing in a bank. But here's the catch. The government wants its share before you even wake up. FWT is a full and final tax based strictly on the gross amount of passive income from sources within the Philippines. The real magic phrase you need to remember here is collected by the payer. The bank, or whatever corporation is paying you, automatically deducts that tax. Because it's a final tax, this income is entirely excluded from your annual income tax return. It never, ever mixes with your regular business or compensation income. It's done, dusted, and final.
Moving on to folder 2, the bank vault hacks. Let's talk interest.
Notice how elegantly simple the general rule is here? Whenever you see typical banking or investment yields in Philippine pesos, your default brain reflex should immediately flash to exactly one number, 20%. Whether it's interest from your standard peso currency bank deposits, yields from deposit substitutes, trust funds, or even government securities, if it's regular, peso-denominated, bank vault passive income, just chunk it all together under this 20% general rule. But wait, what if you step out of the peso and into foreign currency? Welcome to the Expanded Foreign Currency Deposit System, or EFCDS. Guys, this is a classic multiple-choice trap on the board exams. If you're a resident, meaning a resident citizen or resident alien, your foreign currency interest gets hit with a 15% final tax. But contrast that with non-residents. If you are a non-resident citizen, a non-resident alien, or an overseas contract worker, you are fully exempt. That is a massive difference. Residents pay 15%, non-residents pay absolutely zero. Lock that split rule in your mind right now.
Now, let's see how this builds into one of the most brilliant review hacks, the long-term deposit exemption. If you invest your money for the long haul, specifically 5 years or more, the government actually rewards you with a tax exemption. But the rules are incredibly strict. To memorize them, we use the mnemonic INTER5, but spell it with a number 5. It must be an I for individual depositor. Though remember, non-resident aliens not engaged in trade or business don't get this perk. It must be under the N for name of the individual, in T for 10,000 peso denominations, E for executed via banks, with R for receipts prescribed by the BSP. That number 5 stands for the absolute minimum 5 years maturity. And that final T, well, if there is termination before 5 years, you're going to be heavily taxed.
And speaking of that early termination penalty, let's talk about exactly how heavy that tax is. Think about the spatial relationship here. It scales inversely. Basically, the shorter your holding period, the higher the penalty tax. If you panic and withdraw your money in less than 3 years, bam, you're slammed with the full 20% final tax. If you make it 3 to less than 4 years, it drops to 12%. Hold on for 4 to less than 5 years, it's a mere 5%. And of course, if you hit that 5-year mark, you are totally exempt. See how it steps down? 20, 12, 5, 0.
Folder 3, the creator's cut and dividends. Let's look at IP and corporate shares. For royalties, the crucial trick is just knowing who gets the preferential treatment. The government really wants to encourage culture and literature.
Because of this, royalties from books, literary works, and musical compositions enjoy a VIP, lower 10% final tax rate. But if you invent a new piece of tech with a patent or you open up a fast food franchise, that falls under all other royalties. Your default brain reflex for those should be the standard 20%. So just remember, books and music get the 10% VIP pass. Literally everything else is 20%.
Okay, let's tackle domestic dividends. The absolute best way to memorize this is what I call the staircase effect. Imagine a staircase leading away from the Philippines. The further away the taxpayer's classification is from Philippine residency, the higher the tax rate climbs. If you're a resident citizen or resident alien, you're on the very first step, a nice low 10%. Step further away to a non-resident alien engaged in trade or business, the rate doubles to 20%. Step all the way out to a non-resident alien not engaged in trade or business, and you hit the top of the stairs at the maximum 25% rate. 10, 20, 25. Just walk that staircase in your mind.
Folder 4, the jackpot. Time to talk about prizes and winnings.
10,000 pesos. I want you to literally burn this threshold into your visual memory. Take a mental screenshot right now. This specific amount is the absolute anchor point for all jackpot, prize, and winnings-related tax questions you're going to encounter. If a board question mentions a prize or winning, your brain needs to immediately ask, wait, is it above 10,000 or is it exactly 10,000 or below? And here is exactly why that 10,000 peso anchor is so critical. You have to contrast the mechanics between prizes and other winnings. For prizes, that 10,000 peso threshold acts like a toggle switch. If a prize exceeds 10,000, boom, it's a 20% final withholding tax. But if it's exactly 10,000 or less, it doesn't escape taxation, it just shifts over into your regular income tax, or RIT. However, other winnings completely ignore the threshold. General winnings are hit with a flat 20% final tax, regardless of the amount. Seriously, even if you just win 100 pesos in a bet, it's subject to the 20% final tax.
Now lean in for a second because here is the insider secret you need for the LECPA. There is one massive, heavily tested exception to that winnings rule, the Philippine Charity Sweepstakes Office, or PCSO Lotto. While general winnings are always taxed at 20%, PCSO winnings borrow that 10,000 peso prize anchor. If your PCSO winnings exceed 10,000, yes, it's the standard 20% final tax. But if your PCSO winnings hit exactly 10,000 or below, they are completely, fully exempt from tax. Not RIT, not FWT, just zero. Fully exempt.
Finally, Folder 5, the ultimate LECPA bullet review. Let's lock this in.
Here is your rapid-fire recall checklist. Follow along with me. FTW? It's on the gross amount and kept completely out of your ITR. Regular peso interest? Your brain immediately says 20%. EFCDS for non-residents? Totally exempt. Long-term deposit exemption? 5 years minimum. Remember the inner 5T rule. Royalties. Books and music are special at 10%. Everything else is 20%. Domestic dividends. Walk that staircase. 10, 20, 25 based on residency. And finally, prizes over 10K are 20% FTW. But PCSO winnings 10K or below are magically exempt. Look at how neatly all this complex data is now organized in your head.
I'm going to leave you with this provocative mockboard question to test your freshly hacked brain. A resident citizen wins exactly 10,000 pesos in the PCSO Lotto and 10,000 pesos in a mall raffle prize. What are the applicable taxes? Think about those anchors we just built. PCSO exactly 10K, fully exempt. A mall raffle prize exactly 10K, that falls under the prize rule of exactly 10K, so it shifts over to regular income tax. See how incredibly easy that is when you have visual anchors? Trust the mental folders you built today. Keep reviewing these concepts and go totally dominate the tax portion of the LECPA. Keep learning, stay focused, and you've got this.